guys, Brian Stevens here over with Mortgage Shots at the National Real Estate Post. I have Jim Neighbors with me and Valerie Saunders, both of NAMB, the National Association of Mortgage Brokers. We got a new year in front of us. We got a new administration in front of us. We got a whole bunch of stuff changing right before our eyes. Question I have for myself and you should have for yours: what's NAMB doing about it, and what are the most pressing issues? Now, I got to tell you guys both, I love this agenda. I looked at this and I'm like, yes, 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 and yes. This is all great stuff. In fact, to both of you, the first one I want to tackle here is the whole idea of removing loan level price adjustments for investment property and second homes and why it matters. Here's my thing. Loan level price adjustments are inherently biased because we know from the Census Bureau, which is part of the federal government, that people of different ethnicities and different cultural backgrounds, they have different savings habits and patterns. We know this from, the generational wealth discrepancy that we have. So putting a large down payment on a house is going to be difficult for underserved communities. And we also know that credit scores vary amongst different ethnicities. So when you look at loan level price adjustments, it has a disparate outcome, thus making it a disparate impact. And I've always argued if we're looking for a disparate outcome, that loan level price adjustments are going to be a way not to get there. Now, I agree with you on why we're having a conversation about second properties and investment properties. So I'd love to hear what your take is on LLPAs with Fannie Mae and Freddie Mac.
I don't think they're no longer a true risk assessment adjustments. They're just a profit center for the lender. That's all it is. And they increase the percentage of moderate income buyers from being able to afford a home, and at the same time ups the number of people that which gives corporations a chance to go in, swoop in and buy these properties and then rent them out at inflated prices. So we definitely oppose the loan level pricing adjustments.
And I know that you'd mentioned, and of course we mentioned also the second homes and the investment properties, right. But we also oppose the other loan level price adjustments that FHFA imposed that created a scenario where an individual with a higher credit score was paying a higher rate to basically assist the affordable housing buyer to get a better rate. So we oppose, all of those to just be eliminated. We're trying to spur the economy. We're trying to increase the availability of properties. We want people to buy houses, regardless of whether it's primary, second home, or investment. We need the economy to be stimulated by housing.
And Valerie, one of the good points Valerie's making there, it almost gives you incentive to drive down your credit score. Don't pay, well, there's no Sears anymore, I don't think. But, take off a month with MasterCard and American Express. Let's see what it does. Maybe you're going to get a better rate, which I don't think was ever the intent of the plan. But it does seem to basically give you that advantage. So it's idiotic.
And by the way, it's a sad day that we don't have Sears anymore. I can't go into a store and buy Swedish Fish candy, a pair of jeans, a lawnmower, perfume, and a hammer all at the same place. We need Sears back.
All while you're getting your tires changed.
Exactly. And speaking of requiring an act of Congress, this does not require an act of Congress in order to deal with these loan level price adjustments. This is something that could be done, presumably through Fannie, Freddie, or the FHFA, which brings me to a point that's not on our list, but I want to discuss right now, is Trump has his nomination for the head of the FHFA is Bill Pulte, who is the son of Pulte, the builder, the new home construction builder. And are there any concerns of yours that Bill Pulte, if he's running the FHFA, is going to have a biasness when it comes to mortgage lending as it pertains to new home builders? For example, I know a lot of your representative constituents that are members of the National Association of Mortgage Brokers, the loan officers, there's a lot of gripes that we hear about in-house lenders and the fact that they have preferential treatment. And frankly, it appears that if they're violating RESPA left and right, to where I just heard recently that the CFPB is now once again under the old administration looking at different RESPA type of violations for other lenders. Do we have any concerns about Bill Pulte as being the nominee for FHFA, and if that might not be the best move for most of our mortgage brokers out there?
Well, two things. One, they're looking at possibly moving the CFPB under the Treasury Department, which I could understand. The other thing is the Office of Budget Management and Budget, which I don't understand because it's a Consumer Financial Protection Agency. I do have to disclose that I'm familiar with Pulte Homes because they built my first house back in the 70s.
Sure.
I do think that Pulte Homes itself, they did do a lot, build a ton of moderately priced homes. The idea that this isn't on the lending side, but just on the types of homes and the affordability, I believe that's in their blood. That the city I live in, the suburb of Cleveland I live in, I think they built 25% of the homes in where I live, and they were all moderately priced. I like the idea that going into the job, the man already understands the pricing of house. I haven't been that familiar with Pulte's use of in-house lenders. In fact, you're the first time I've heard that come up.
I just had this down in Texas where, and it's not Pulte, it's new home builders in general. I don't mean to single them out. Okay. It's just that it is Bill Pulte in particular, who happens to be the son of the person who started Pulte Homes. But this is a big issue for loan officers right now. And, one of the things one of the reasons why we have RESPA and I can't go ahead and pay a real estate agent is because there's a belief, and I think we all agree with this, that cost is going to find its way down to a rate sheet and ultimately cost the consumer more money. That's the idea behind it. And in the spirit of competition, why don't we hold new home builders to the same standard that we hold everybody else, where they do have their in-house lenders and they are commingling these type of things? And this is a big issue for loan officers. And I guess my question is Pulte, where it runs in his blood that he's coming from the larger conglomerate new home builders, is there any concern that maybe that issue isn't going to be addressed? Because I think that there are a lot of lenders that see a disparity between the standard that new home builders are held to and the rest of us plebeians.
So I want to just make a couple of comments. NAMB has had a long-standing call to action based off of exactly what you're saying. There's a lot of mortgage brokers who put a lot of time, energy, and effort into their borrowers, get them into a place where they are able to now purchase a home, and they go look at a new construction or a spec home from a builder, and they're like, oh, well, we'll only pay all your closing costs if you use our in-house lender, or we'll only give you these upgrades if you use our in-house lender.
Correct.
So we have long had an ongoing, request of the industry to have a level playing field. These types of situations shouldn't occur, to basically force a consumer to go with a potentially higher rate, potentially higher closing costs, because something is going to be taken away from them if they don't use something else. I think it was back in, I may not be going back far enough, but I think it was 2013 when RESPA did attempt to impose a restriction on builders kind of doing that, but it never made it to the final. It was taken out during commentary. Now, 12 years later, we're still talking about it. So whether Pulte is the FHFA director or not, it's not like we haven't been dealing with this issue well before him, and chances are we're going to be dealing with the same issue well after him.
Right. In the early 2000s, the first time NAMB got involved in this, it was a builder in Florida. If you used his financer, he gave you a pool, but otherwise you were on your own. And we would get together, and as we're trying to explain it to us, we had one of our very expensive lobbyists go, but they're going to get a pool, because they were looking at it from the borrower's standpoint. Yeah, my rate might be 0.5% higher, but I'm going to get a pool. And it did go to court, and I think the judge's response was, but they're going to get a pool. They don't understand. Okay, if the borrower knows they're going to pay a higher rate.
If that's disclosed, but it's not disclosed.
Yeah, but
that's the problem. It's that point is not disclosed. And you're absolutely right there, Jim. It's, hey, do you want granite countertops? Do you want hardwood instead of laminates? Then you got to use my lender. Oh, by the way, my lender is you're going to finance this over the next 30 years with a higher interest rate. In the spirit of consumer finance and in the spirit of RESPA, this should at least be, it appears to me to be a violation. It's interesting how Bill Pulte, for our first two topics, he really is the person who we'd want to talk to who could actually address both of these issues with low-level price adjustments when it comes to our in-house lenders. These are all fantastic points. I want to move on to the next one now and just keep this thing moving along. Affordability. It's gone. Is it ever coming back? We don't know. Nobody knows. I just read a study a couple of days ago that said only 24% of people who wanted to buy a house in 2024 were actually able to do it, meaning we've got 76% of people who could, would, and should have bought a house, but it has become too difficult, too expensive for them to do it. And when we look at our affordable housing options, and I happen to have this with a great program in front of me, and I got 80% of my area median income, and that's not going to get you half the house, let alone the whole darn house. How important is it to increase our area median income threshold from 80 to 100%? And frankly, and you have it for a home ready loan, but frankly, shouldn't we even be going further than that in some markets?
Well, I think we should at least be going to 100%. The 80%, the difference between 80 and 100%, there is no increase in delinquency or losses. So I think, you can't use that as an excuse. The problem with affordability of houses is just the cost of housing. It has nothing to do with the interest rates. Yes, the interest rates are too high, but they're the same interest rates that existed in the 70s, the 80s, the 90s, 2000. I mean, a lot of people got spoiled by that 3.25, 4, and but you can't base it on a pandemic. Pricing during a pandemic. You have to look at traditional pricing of where have interest rates been over the attrition. So it's not so much a rate issue. It's the cost of buying a house. It's the cost of the house, and I don't see how you can bring the price of that down for existing homes that are already built. The person that lives next door to me just paid, I think, a good $90,000 more than I would have paid for the house. Now, that was their option, and they were able to afford to do it. But a lot of people, as you're saying, don't have that ability to overpay for a house, pay $405,000. Again, I'm from Cleveland, so $400,000 may not sound like a lot of money in a lot of the areas, but $400,000 in Cleveland, Ohio is a lot of money for a house, where that house is maybe a 320 house or maybe a 270. Which is more affordable. But you have to look at is, if you're looking at developing new homes to buy, a 2x4 costs the same to build into a $200,000 house as it does to use that 2x4 in a $600,000 house. So if you're the builder, what's the incentive you already got the lot? Where's the incentive? It's to put it into a more expensive house because there's more profit there. This is not an easy solution that the mortgage industry is going to solve. This is a housing problem nationwide as millennials continue to enter the market, and they don't want to live at home. They want their own single family home. What can they pay? What are they willing to pay? The question is where, if the government's going to get involved in developing more affordable housing, they're going to be in areas. They're either going to be in areas out farther from the main area, the main city, or they're going to be closer into the city, and gentrification of those houses, those areas. So it's a tough one, and I don't know. Maybe Valerie has a solution, and that'd be great. But I just don't see a solution on this. Where if you brought rates down to 3%, I think housing prices would just go up. Yeah,
they would. Jim, excuse me. We actually proved this it was proven in Japan when they came out 20 years ago with the 100-year mortgage. They came out with they called it a generational mortgage, and they found after a decade of doing this that the only thing it did was it became a tax haven for the wealthy, and they figured out how to utilize it by handing properties off to their children. What happened is when you had a 100-year mortgage, people just bid houses up to whatever they could actually afford at that time. It doesn't matter if it's a 30 or 100. I think you're absolutely right on that. And by the way, Valerie, if you do have the solutions to this, when you send that over to Jim, make sure you send me that memo too, because I want to know what the answers are as well.
Get right on that.
Okay, it's interesting how Bill Pulte might be the linchpin for all of these type of things. But yeah, affordability is a big problem, and our AMI absolutely has to go up. And I'm super, super happy that you guys are looking at this right now, because I think it's huge too. Here's another no-brainer. GSE refinance rule from 12 months to 6 months. We're trying to find a way to put more cash in people's pockets. And if we do see that big rate dump, and none of us know if that's going to take place, but if it does happen, and we end up in the magical 4s and 5s, and somebody recently refinanced down to a 7% or a 6.5%, why are we withholding that savings from people? What are your thoughts on this?
I mean, even if it doesn't happen, it's not like credit card interest rates are in the 6s or 7s. They're at 18%. So, you have a high amount of equity built up in your home, but Americans are now going back into having one of the highest amounts of credit card debt. Why should you be limited from taking advantage of the equity in your house to pay off credit card debt, or to help put your kid through college, or to pay off existing student loans? Why can you not use something that you have worked for to your advantage? Why does the government want to handcuff you and say, no, we don't think you should do that within 6 months or 9 months or 10 months? 12 months is the magic number. And I think it's just, it's unfortunate that sometimes the government, we're here to help, is really here to hurt.
And if you think about it, to whose advantage is this 12-month as compared to 6 months? Whose advantage is that? The servicer.
Those invest in mortgage-backed securities.
Yeah. So if rates were going up, would they want 12 months, or would they say, hey, let's do 6, let's waive it all together?
Yep.
It would be
Great
going,
point.
okay, we want to out of it. They see what they got. Again, as Valerie said, I'm talking to someone that's looking to upgrade his truck, and the truck he's looking at costs $100,000.
Yeah.
And I'm like, what the hell is the payment on that going to be?
Yep.
And he's like, he told me what the lease payment was going to be, and I'm like, you realize if you refinance your home, you'd be saving $700 a month.
Yeah.
Because, I constantly keep telling people from day one I got in the industry, you don't make a monthly interest rate, you make a monthly payment. And everything's about what's the payment and what's the payment you can afford. Doesn't matter if the rate's 3% or 18.5%, can you afford the payment? And, it's just getting people to start thinking about, I got to look more at the payment than I'm sitting here waiting for the interest rates to drop, another percent before I even look at buying a house. If you can make the payment, make the payment. Well, this, and I know that's a little off the topic here, but, to me, this kind of fits in there, because to me, the lenders are like, no, hey, we like these rates. We want to earn this interest up there for 12 months. Instead of 6. And as Valerie hit it on the head, if your kid's going to college, you want to get them into a student loan that you have no idea what the interest rate's going to be or how long it's going to be for, when you got the equity in your home.
Yeah, I completely agree with you. And by the way, I'm dating myself right now. I remember thinking a $300 was a reasonable car payment when I first started writing loans. And I had somebody who had like a $1,200 car payment. And I remember asking the guy, he was a flight surgeon who just came over from Germany. And I asked him, I go, what the hell are you driving? And I'll never forget, the guy said, yeah, and I put $40,000 down on it too. And he was proud of this. I couldn't believe that he hamstrung himself with a $1,200 car payment. And the truth of the matter is that's just a car payment today. You're right on that $100,000 truck. That's the norm. And, as far as it not refinancing for 12 months, I thought Dodd-Frank did away with prepayment penalties, because that's essentially what it boils down to. Right?
Yeah, in reality, that's what it is.
The last point I want to talk with you guys about, and this is getting back into writing loans as I've done, we're building our brokerage over here at Capital Direct and doing a fantastic job with it. Having been removed and speaking around the country with you, the likes of you folks, for the past 20 years, one thing that shocked me writing loans again, just actually caught me off guard, didn't expect it, was the enormity of the costs. Consumer protection equals higher fees. If that's what consumer protection is, leave me alone. And Valerie, I think you missed the other part of the quote, and it was one of the 9 scariest words in the English language per Ronald Reagan, and it's "I'm from the government, I'm here to help." Right?
Right.
But the real big one was credit reports. I mean, aren't they making enough money selling trigger leads that they can pull the costs of credit reports down? These things are absolutely out of control.
It's predatory.
Yes.
You don't have another option on where to go. So here we got, again, dating myself. Tri-merges used to cost $12.50.
Yep.
Now they're talking between $100 and $400, depending on what you're going to do. All right. And then, of course, it's also, it's a required expense. So why is it required in the calculations of the points and fees? It shouldn't, it's a third-party fee. It shouldn't be included in the calculation there. But still, what did they do to justify what additional value am I
How did the product change?
Yeah.
Right. How did the product change?
Yeah, so that they can go from $50 to $300.
Right.
with the exception that you have no other option.
Right. Well, and even, 10 years ago when we were talking about TRID, there's somewhere in the commentary of TRID that references the cost of a credit report as $25.
Yeah.
I mean, that was only 10 years ago, and it's gone a minimum of 200%. I mean, what else has, increased that dramatically in the last 10 years?
And this is going to start playing into with trigger leads too, because what's the one fee that a mortgage originator is allowed to collect up front before the borrower gives you the intent to proceed? The cost of the credit bureau. And what's the one fee that we pretty much don't collect up front? The cost of the credit bureau. We just build it into the loan. But when I pull a credit bureau and then they turn around and sell all the information I provided to them to 45 or 50 different companies, all of a sudden we're going to start collecting this fee up front, which is non-refundable. And how many people are going to be, particularly the elderly, are going to be talked into paying this fee 2 or 3 times by 2 or 3 different people that are calling them on it and talking to them, and, well, I'll save you money. I don't know, just tell me what rate they gave you or quote what cost they gave you, and I'll get that down. It's just, I just can't quite figure out why the government has decided to let the credit bureaus all of a sudden to become predators. Yeah,
I mean, they want to encourage shopping, but they're almost prohibiting it or severely limiting it because, like you said, the first thing they're going to want to do is pull credit. Well, 3-4 times a first-time home buyer or a senior or an affordable housing borrower is supposed to pay for the cost of a credit report and then make a decision. So now they're already $400, $500 in, and they potentially haven't made a choice and don't know if they're even going to get the loan.
Or the flip side of that, how many of them are not going to shop their loan as they're being told to do to see if they can find a better deal out there because the cost has become too prohibitive because everyone's going to pull their credit? It hurts on both sides. This makes absolutely no sense to me, and I couldn't believe it. And again, the trigger leads, aren't they making money for that? And the one that I found interesting is when we came out and said we're not going to put medical collections on there right now, it was the credit bureaus who were the first ones to file a lawsuit to ensure that those medical bills stay on credit reports. And I was asking, I said, why in the heck would they do that? They said, because it costs money that they pay out to the credit bureaus in order to get those filed with the tri-bureaus. Right. So it is. This is a really ugly money grab, and it's going by and large overlooked. So I love the fact that you guys put a spotlight on this. This one's massive. We don't really think about it until we pull a credit report, and then you go, damn, that's expensive. And you kind of forget about it. But this is a huge issue that's costing, I would imagine, presumably billions of dollars to consumers. And in the spirit of consumer protection, all of these points not only make our industry and our loan officers better, but everything you're doing is advocating for consumers as well. You guys hit the trifecta on this stuff. I think it's great.
Thank you.
Well, we appreciate that.
Or the quadfecta, whatever we want to call it. Or the pentafecta. Whatever the case may be. Guys, you're killing it with this stuff. Stick with it. You guys are, as far as I can tell, one guy's opinion, you guys are on the right path with this. So I appreciate you doing this, and I appreciate you advocating for our industry.
Anytime.
Thanks for giving us the opportunity to talk about it.